Hello and welcome to BQ Prime. A very good morning to all the viewers. I'm Hiro Dadia, and joining us on the show is Pankaj Pandey, Head of Research at ICICI Direct, to discuss about the movers and shakers in trade today. Welcome to the show, Pankaj, and a very good morning.
Hi, good morning.
Pankaj, let's pick up ITC first. Clearly, the stock has been hitting life high levels. And overall, today, there are news reports suggesting as well that there is a probability of the demerger with regards to where the hotel business goes. Now, this was something that was on the cards, was pushed due to the pandemic, and now the management is really looking at it once again. What's your sense that you pick up on that front?
So ITC, our target price is 500. See, last few years, if you look at taxation has been pretty stable, and that has sort of led to volume growth of about 19 odd percent. Going forward, we expect volume growth to be in single digits of 8 and 5%. So cigarette business is sort of doing well. Now the when you sort of look at the FMCG business, now FMCG business also has sort of done well. We have seen 11% kind of a growth in the last 4 years, and last quarter the margin was one of the highest. Company is looking at 100 to 150 bips kind of a margin improvement every year. Now, hotel business is another business which has sort of done very well. Occupancies are 70%. When you look at ARR, those are good at good levels and much higher than the pre-COVID levels. And so fundamentally, when you sort of look at most of their businesses sort of shaping up well, now hotel business consumed a lot of capital employed. And I think what the management is guiding for is more of asset light model for expansion of the hospitality business. And which is why I feel that company is sort of placed well for more in most of the business parameters. Now, when we sort of look at valuation, typically a cigarette is valued at 22 times and FMCG at 6 times. So we are comfortable even with the valuation. And with most of the business looking up, I think any kind of unlocking can be a sort of a good opportunity for stock to sort of keep doing well.
Right, so that's with regards to ITC. Moving on from the real estate pack, you have Soba, which has reported numbers. In fact, it's the best ever quarterly sales. The stock is surged in trade as well. What's the sense that you pick up, and do you think this could be one of a bet that an investor should have in their portfolio?
So when you sort of look at real estate has started to perform because we've seen 200 bips kind of a hike, rate hike, and now our sense is that most of your rate hike is behind us, and probably we'll get some sort of a rate cut going forward, given that inflation is no longer a worry. Shobha has sort of done well in terms of their booking, even in terms of numbers. But I think our top pick in real estate is Brigade Enterprises, which operates in the similar geography of Bangalore and Chennai. Lastly, because when you sort of look at real estate players, our sense is that on the residential side, you really do not need too much of a debt to sort of run the operations. So from that perspective, I think Brigade looks far more efficient player. So I think that remains our top pick within the real estate as the overall.
Right, so that's with regards to Sobha. Moving on, another stock which is actually buzzing in trade on the back of earnings is Hikal. The stock has surged almost 12%. Clearly, the sales number up around 8.5%. Profitability also pretty strong. What's your view?
So when you look at Hikal, last 1 year or last 2 years, the stock has done very badly in terms of price performance, and even the fundamentals were also not really supporting. But I think what is really sort of helping the stock today is because now in the con call, the management has clearly said that the ongoing feud between the promoters will not lead to any kind of an impairment or any kind of a delay in sort of capex decisions. So I think that's a sort of a big relief because there was a concern that the overall growth could get impacted. So I think so there is a comfort on that side. The other thing is that when you look at Q1 last year, the margins had come down to 6%. Now the margins have improved to 16 odd percent. Management is guiding for about 12% kind of a margin uh, in FY24. So that is another positive. And I think the other thing is that companies are looking to sort of shift from say generic CRAMs to sort of innovative CRAMs. So which is a sort of a better margin profile business. So previously our target price was 375. I think we are still sort of working out numbers, but I think overall management commentary looks quite positive. So I think that is going to help the stock in the near term.
UltraTech Cement is another one which is in focus now. Clearly, industry leading performance is what we've seen both in terms of volume growth as well as profitability in the fourth quarter. However, the management is cautioned on the cost front, stating that while current pet coke and coal prices are lower, China remains a key factor in determining the future coal prices. Taking these aspects into consideration and the valuations, Pankaj, what should an investor who's holding the stock do? And is there a good entry level for a new investor?
So cement as a pack we like because largely because a number of factors. One, when you sort of look at say UltraTech specifically, here our target price is about 9,000 rupees. Now, company delivered 16% kind of a volume growth. In fact, in the month of March, the capacity utilization was 100%. Typically, most of the cement companies are not pushing for pricing growth, but more of a volume growth. And because of operating leverage, we have seen EBITDA per ton sort of improving. I think on the capacity expansion, also company is guiding for 154 million ton kind of a capacity by FY25 and 200 by 2030. So that is sort of implying a growth of 7% plus. I think when we sort of look at the input prices, our sense is that while these prices have corrected by 25-30%, the benefit of that will accrue in probably from Q2 onwards. So, which is where our sense is that even that is also sort of looking attractive. So, while next quarter we may not see that benefit, but a quarter after that we will see the benefits of lower input prices also sort of happening. And I think one more thing what we are looking at is that ahead of elections, it is possible that government might or we might see higher tendering and ordering activity, which will again sort of benefit cement as a overall pack. So UltraTech, I think, hasn't seen much of a price performance, about 5% in the last 1 month. Our sense is that the stock is still looking good with a target price of 9,000.
So that's coming in terms of UltraTech Cement. Moving on, ONGC is in focus now. It's mainly the tax provision as well as a higher OPEX that has led to the miss in terms of earnings. However, the outlook remains pretty steady for the stock. They've said that they will be investing with regards to 2038 being net zero target and a good amount of investment coming in there. Overall, what's your view on an ONGC?
So while they have given net zero target, but that's a sort of a longish target. Why we are sort of liking ONGC is one, obviously the valuations are cheap. So here our target price is about 190. Now, reason for liking is see two three things. One, we are seeing a production improvement or production growth after a long period of or many quarters. So one is, I think, when you sort of look at on the gas side, the company is looking to sort of ramp up the production from KG-D6 to about 11 MMSCMD. Similarly, the production for ONGC Videsh Limited, which was around 10 million tons, is expected to sort of normalize to 12 million tons. And even domestically, also they are looking to sort of they are looking to sort of produce more oil from KG the basin. So I think after a long period of time, I think company is consciously focusing on more of production growth. And I think that is where we feel that the stock will benefit because typically ONGC has not seen much of a production growth. And I think it's no longer a play on the crude oil direction of crude oil prices. I think if we get production growth, then I think it's a sort of a better vector to sort of look at. So from that perspective, I think ONGC with a target price of 190 is looking better after a long period of time.
Right, so that's an attractive bet coming in there. Techno Electric has been trading under pressure, Pankaj, and this is after the FY23 profits slumped almost 29% overall. There is a downtick in terms of revenues as well. What would your view be on this counter?
So we were carrying a positive view with a target price of 500 on the stock. Last 2 quarters, the company has been disappointing on the overall execution front. So in both the quarters, there has been a sort of a revenue miss. But I think we'll sort of have a word with the management, and then probably we'll make a more concrete view. But why we have been liking this stock is that this is a leading power infrastructure company, and has got a good sort of a cash. Overall, the cash levels are about 1450. Debt is zero. Uh, then other thing is that they're sitting on a good order backlog of about 4,000 odd crores. So our sense is that everything is in place for this stock to do well. There has been execution miss in the last 2 quarters. I think we need to sort of figure that out. But in general, since balance sheet is not deteriorating, so we are not that unduly worried with the kind of decline or the kind of beating the stock has seen today.
Right. From the pharma pack, Aurobindo Pharma is an interesting play because it's had a spectacular run in the last, say, 5 to 6 months. The kind of uptick it has picked up from the month of February itself from a stock price performance, that's pretty strong. YTD, it's up around 45%. And if you see in terms of earnings, the US visibility, it seems, is improving for the company. Overall, Revlimid is expected to be launched in October 23, and the management is guided to improve the operating margins to 17 to 18% from a 15.5% for FY24. Clearly, it seems that it's leading the pack in terms of the pharma names. What would your view be?
So, Aurobindo, if you sort of look at a bit longish picture, we haven't seen much of a stock
Hmm.
price performance in the stock, largely because see, US has been a pain market. The US contributes about 46 odd percent of the overall revenues, and now the challenge is that the oral solid, what the company is saying is that the pricing decline is sort of so they're not expecting a bigger price decline. So largely those price erosion has stabilized. I think good part is that what they're saying is that 26% of the US of the overall top line, which is into injectables, I think that is likely to grow in double digits. But when you sort of look at, or when you sort of put all that into numbers, what you get is about 10% kind of a top line growth and 30% kind of a bottom line growth. But when you look at return ratios, I mean, ROEs could be at about 10 odd percent in FY25. So that's not really very good sort of ROEs to sort of look at and to sort of recommend a stock from a buying perspective. So which is why we have been sort of maintaining a hold on the stock for quite some time, and that does not change.
Right, so that's with regards to Aurobindo Pharma. Moving on, TCNS, they've reported numbers. Sales are up around 14%, a loss number at 28 crores, and the EBITDA operationally is also down around 62%. What would you advise an investor who's holding a TCNS do?
So one is we all know that this company is going to get acquired by ABFL, so at a price of 503.
Hmm.
Now, but when you sort of look at operational performance has been weak. Revenue recovery is only 93%, and overall full year the revenue recovery might look at 102%, but that is still lower than what you see 130% plus for something like Trent or other players. The other thing is that company had launched W range, so that has sort of failed in the sense that the company is now liquidating that inventory, and as a result of that, we are seeing pressure on the gross margins. So I think, except for a trigger like being acquired by ABFR, the fundamental performance is quite neutral. And I think till the time it's better to sort of wait and watch out for how the new management would want to sort of shape it up going forward before chasing the stock.
Right, so that's with regards to TCNS. JK Cement is another one. We've already spoken about UltraTech, but here as well, the profits have dipped overall by around 44%. How are you looking at a JK Cement taking market share and valuations into consideration?
So JK Cement, previously we had a buy rating of about 3,350. Now, so that was 20% plus upside, but now the stock has sort of rallied. We have already seen the stock rallying about 10% in the 5-6 trading sessions. Now, we'll sort of look at our target prices post management con call. Now, when you sort of look at numbers, the volume growth continued to remain impressive. So volume growth was 17 odd percent, largely because they had expanded their capacity. then I think good part is that while most of the cement companies have seen decline in realizations, this company has seen an improvement in realization. So EBITDA per ton also came out at healthy at about 900 plus. Now, other thing is that they are expanding their capacity by another 5 million tons. So this incremental capex is going to come at about $27 per ton. So which is quite cheap, and which we feel that once this when this capex is put into action, the overall return ratios will improve for this. And like I said, the benefits of lower input prices will pan out for most of the cement companies, including this one. So largely, while we'll work out the numbers, but we have been maintaining a very positive bias, and in general, we are liking cement as a space overall from even from current levels.
Right, so cement as a sector is the highlight of for coming out of this chat as well. That there should be good prospects, as Pankaj has been saying. Thank you, Pankaj, so much for joining us on the show and giving us those views on the counters. But clearly, if you see in terms of markets, there is some amount of volatility. We are seeing consolidation, and clearly we have dipped somewhere into the negative as well. Pretty much on the borderline right now in terms of Nifty 50, and the advanced decline is pretty much favoring the declines as well. In terms of stock specific action, ITC is the top gainer, followed by Apollo Hospital, which will be reporting earnings in today's session. JSW Steel, ONGC, as well as UltraTech Cement are the other gainers, whereas HDFC Life, Tech Mahindra, Dr. Reddy's, Hindalco, as well as Adani Ports is trading under pressure. You have Bank Nifty as well, which is marginally in the red right now, but it's been volatile there as well. And we are below the 44,300 mark. And the advanced decline ratio in terms of Bank Nifty is pretty much in favor of the bears as well. If you see in terms of where a larger market goes, you have the Sensex as well, which is trading below the 62,850 mark as we speak. And overall, let's quickly look at all the stocks which are actually pulling the markets lower today. So you have the likes of HDFC, TCS, Sun Pharma. These are the ones which are putting pressure, but the ones which are helping Sensex stay afloat is ITC, which is contributing to the tune of 12 to 13 points, Reliance Industries, HCL Tech, UltraTech Cement. These are a few of the names which are helping Sensex balance out as well. So clearly, it's going to be an interesting day of trade. Clearly, there is some bit of consolidation that we have been witnessing. Resistance levels are pretty strong. That's what is coming out so far. So let's see how we end in today's session. That's all that we have. Thanks for watching and have a great day as well.